There are sound reasons why gold has been the best store of value for 4,000 years, more reliable than any other commodity, including the new electronic varieties. Here's why. Gold is rare, but not too rare. The gold supply grows, averaging an increase of nearly 2% a year. Despite advances in mining technology, that average is held, which is not true of other metals such as silver or copper. The supply of Bitcoin, in fact, is fixed. Gold can't be destroyed, it can't be consumed. Every ounce that's been mined is still in existence. So why hasn't the price of gold surged recently? Critics overlooked that the yellow metal went up around 50% between summer 2019 and the summer of 2020. Since then, banks have been holding lots of cash, as have consumers. But that is about to change, big time. The Biden administration is determined to shovel out the $1 trillion from previous pandemic relief measures that remains unspent. It'll soon try to ram through Congress another COVID-19 bill of almost $2 trillion. Now that number might be trimmed, but it'll still be a whopper. The White House wants to follow that with an additional $3 trillion for infrastructure. And it wants the Federal Reserve to print the money to pay for all of this, which the Fed seems all too willing to do. As this tsunami of cash floods through the economy in the second half of this year and going into next year, inflation will surge, and so will the price of gold.
And so what gold really does is protect you from an environment where inflation is much higher than the bond yields. And that's what we've seen over in 2020 is that you saw, gold, over the past couple of years, gold had a pretty big appreciation because it was protecting against that. But now since about, late summer of 2020, negative real yields have been roughly flat. They hit a bottom of negative 1.08% on the 10-year, and that's been kind of choppy and sideways since then, which is why we've seen some consolidation in gold. I do think as you look out a couple of years, maybe in late 2021, I do think that inflation could rise faster than bond yields, especially because the Federal Reserve has some tools they can use to suppress the long end of the curve and keep that submerged below the inflation rate. And if that were to happen, that'd be very good for the precious metals and particularly gold.
Could you very quickly and in layman terms describe to somebody with very little financial backgrounds as to why they should buy gold, the purpose of buying gold?
Gold is a yieldless asset. And if anything, there's a slight negative yield because you're paying either security costs or, transportation, shipping, all these storage. Kind of, frictional, storage. So it's but you can basically call it a zero yielding asset. However, unlike treasuries and dollars, it's a scarce asset. And so there's about 1 ounce of gold per person in the world, estimated by the World Gold Council. And so they're not really making more of it, at least compared to the population growth. And so it kind of has that built-in inflation hedge in the sense that as broad money supply increases over time, gold does gradually appreciate. It just doesn't have these big spikes unless you have these dips in the negative real yield. Okay. And so it's really kind of that protection against periods of time where treasuries are failing to keep up with inflation, which is what we've seen over the past couple of years. And I think we'll expect to see, but not in a straight line. I think we'll still see gold likely do well in the years ahead.
The governments aren't complacent and they don't just ignore us. And I keep thinking, well, they say, yeah, but you warn about some of the problems they could have with crypto and the government invading and sending you a tax bill and all. And I said, yeah, but the problem is more universal. Just think of what they did in 1933. They stole all our gold, and we weren't even allowed to own gold all the way up until 1975. So it's this issue of the relationship of government and central banking to the people that's a big issue. So I admit I'm not an expert on how the technology provides the cryptocurrency, but I'm really interested in competition to allow it and to point out the shortcomings of central banking. And I think that's what's happening. People will think, well, these central banks, they only know one thing, and that is print more money.
But I think one of the reasons we've seen nerves calmed, really, and people perhaps look for riskier assets than gold, is the impact that the various vaccines are expected to have. It's been a few months since the coronavirus vaccines were announced. There is, a hope that we're going to see some sort of return back to near normal. We've seen stock markets still strong. Okay, a bit volatile this week, but yet again in February, US stock markets hitting fresh all-time highs. And I think that's another reason why we've seen people turn away from gold. One of the environments that gold does well in is inflation. When we have inflation concerns, the cost of living rising is something that can help the price of gold because it's seen as a hedge against inflation. One way that investors get exposure to gold is using popular ETFs, such as the Spider Gold ETF. I know there's always loads of discussion whenever we talk about ETFs for silver or gold. Occasionally people are very passionate about holding physical gold rather than holding paper.
The long-term chart for gold is still looking very strong. If you just zoom out and take a look at 2 to 5 years, we're still at a very high point.
True. Again, but if you're a trader, this market is, if you're long, I mean, you could be short and then you're happy, but if you're a trader and you're long this market, you're not feeling very good right now. Again, as an investor, again, the broken record scenario, it's part of your portfolio and you make adjustments. So if it was 10% of your portfolio and now you have this downdraft, you recalibrate your portfolio, and if gold's at 8% or 5% because of this drop, then you add to the position in gold to bring it back to 10%. And that's the way you have to do it as an investor. And if the market rallies and your position is now not 10 but 14% of your portfolio, you sell 4%. And you need that discipline whether you're buying gold or Apple stock or anything else. You just recalibrate your portfolio either every 3, minimum every 6 months, and again, you keep your weighting where you want it, and you add or subtract to that weighting depending on which way the market moves.